Hey, good morning, everyone. Welcome. I hope you're all doing well. It is Friday, July 28th, and we got a few things to talk about. Yesterday, we had a pretty big sell off in the market, and everyone's going crazy about it. What happened? Blah, blah, blah. Well, you get more sellers than buyers. That's what happens. So today, we're going to see how Friday shapes up. We held the bottom of a distribution. We'll talk about the trade plan for the S&P 100 futures at the end of this, but let's talk about some of the central banks first and foremost, right? Huge week for central banks. The Bank of Japan, though, right? They had to get in action after a further round of rate hikes out of Europe and the US. So the BOJ remains an outlier on the world stage in the face of historic inflation, maintaining an easy monetary policy stance with its so-called yield curve control. So in fact, it's the only prominent central bank to still keep its rates in negative territory, but signs of creeping price pressures, impacts on the balance sheet, and side effects of prolonged easing, like the weakening of the yen, mean that the institution cannot continue down this path indefinitely. So the BOJ already widened its bands last December, allowing the Japanese 10-year yields to rise around to about 0.5%, crazy, or double than the previous upper limit. Building on the steps, the central bank today kept the target for the 10-year JGB yields at around 0%, but said 0.5% ceiling on the yield movement was now reference and not a rigid limit. It will also offer to purchase Japanese government bonds in at a fixed rate operations, effectively setting a new hard cap for the 10-year yield at 1%, while if you go to the US 10-year, it's at 4%. So just to give you a reference point. So yield curve control is a dangerous policy which needs to be retired as soon as possible, said Kit Yucks, chief FX strategist at Societe Generale, by anchoring the JGB yields at a time when other major central banks have been raising rates. So it has also been a major factor in the yen reaching the lowest level in real terms since the 1970s. So the BOJ wants to be very careful in dismantling YCC, and the yen will rally as slowly as they do so. So for the moment, that means that there's little upside in the pair USD JPY, but the fall from here is likely to be very slow until the global trend in bond yields turns decisively lower. So that's what the central banks are doing. In other news, we do have US economy news is showing further resilience as GDP growth at a 2.4% annualized rate in Q2, almost a full percentage point stronger than the 1.5% expected. So the growth was driven by robust consumer and business spending, while durable goods orders separately showed the fourth straight month of growth. A soft landing may be turning into a base case for strategists, but those who are looking to hedge stocks longs, Bank of America, I should say, explains why it's never been cheaper to buy protection. Because VIX at freaking zeros. VIX is really low. Volatility is really low, putting downside pressure in options premiums if you're looking to hedge with options, right? You could also sell options to generate income and also add that as a hedge. In terms of financials, right, we talk about more capital. U.S. regulators have jointly proposed an increased capital requirements for banks with more than $100 billion in assets in the so-called Basel III endgame. The changes will likely result in a 16% increase in common equity tier 1 capital requirements for the affected companies, with the increase principally affecting the largest and the most complex banks. So global systematically important institutions include Bank of America, naturally, JP Morgan, and would still be subject to stricter standards. While the new proposed aims to strengthen the regulations of large regional lenders, such as Key or Huntington Bank Shares and Regional Financial. Interesting. So I still like the potential increase in the regionals. Where is this chart? Let's see here. Give me a second. What was that? What was it? KRE? Was that the ETF? It's doing pretty solid after those lows, but I think we could have a move into like 56, 57 on the KRE, which is an ETF for the regional banks. But Without further ado, let's talk about the trade plan. It's Friday today, so I'm probably going to be trading very, very small size on the futures, talking about S&P 500 futures. Had a interesting last 2 days that were fairly tough. But right now, what we're getting is we actually accepted the bottom band of the distribution at 45.55, which I was talking about to the team yesterday, that was our long idea. I didn't hold the long this whole way up, but the thing's up like 40 handles, right? So the top of the distribution, 46.10, the bottom, 45.55. We're holding both areas fairly well. Strong bullish move here pre-market. I think I'm going to watch to see if some of these dips get picked up, maybe into the low mid 80s. I'm going to see how this low 90 interacts as well. But if there's some kind of sell pressure, I would rather it come out at 46.10 to hold that region. So far, we're still in the balance. I just want to play the extremes of the balance, meaning that 46.10 is a key area and 45.55, obviously. In between, you have 92, and below that, you have 80. So keep that in mind for the S&P 500 futures. What we're going to do is open our live trading room for our traders today. Let's see what kind of trades show up. We're going to trade these things live. We're going to talk about trades, show trades, all that good stuff. So if you guys want to learn more about that, we also have a free futures course, which is available on our website, tradeproacademy.com. But otherwise, let's open this trading room and chat soon. Have a great weekend, everyone. We're going to talk to you guys on Monday. Maybe. I actually have a flight on Monday. We'll see. All right. Take care, everyone.